I don't want to answer your question about the recession.
NASDAQ 100 on a tear up 0.8% as well. The 10-year yield comes in ever lower. Bond prices up, yields down.
All right, friends. Thanks for joining. I know I said I wasn't going to make any more portfolios, but you know what? This one's just too much fun. I think we have to do it. So this is Sunday night, November 5th. I'm just laying out the positions here and the weights and whatnot. We'll be buying tomorrow morning for the most part. This is the speculative degenerate portfolio. Yes, you read that right, degenerate. Variable leverage, potentially long short, currently just long. Definitely not to be followed by anyone for any reason. This is not investment advice. You've heard that before. But this one is really, truly that. There's a lot of junk in here, and you know, why am I buying junk? Well, we'll get into that. We'll talk about that in future videos, but there's reason to my madness, or logic to my madness. Yeah, so it's more diversified than others in the weights, more even, I would say. We don't have any large outsized weights like we do in the growth portfolio. We are doing 110% on the equity side initially. Well, not initially, actually, because if you see here, I'm learning from my past mistakes with the medium growth portfolio. We're buying on the open if less than a 5% gap up, so I'm giving myself a little bit of an out here tomorrow. Futures are not currently up. Everything's flat, so I don't have any, any view into what's going to happen tomorrow morning. So no foresight of any sort here. Not that it would matter, because I mean, we're buying on the open. We're not backdating anything. We're just saying we're going to buy on the open, but we're not going to buy unless, if something's up more than 5% on the open. Just because, we got burned by that last time with Camping World, up 25% the next morning, when I wanted to buy it 25% lower, and I, sticking to my word with sort of the intellectual honesty of this, I basically said, okay, well, I said I was going to buy on the open, so I guess we're buying it, plus 25% with a 3% weight, which is, big position relatively. So yeah, so learning from my mistakes, we'll buy on the open, but I'm going to give myself an out here. If it's less than 5%, even 5% or close to 5%, I'm not going to be happy with. But if it's less than 5% gap up, we'll go ahead. The other ones we're going to wait for a pullback, because so many of these are up 20+% in the last week or two. I just hate chasing things. I like to buy things when they're on the decline, when nobody wants them. That's my modus operandi. I have a tough time chasing, but it's my weakness for sure. So yeah, and so 110% on the equity side, as I said. We'll leave some shorts as possibilities here, so almost like a watch list, if you will, sort of waiting for the right time to short these. Maybe just out of curiosity, we'll take a really quick look at Trepanion. Trepanion is the one that I would be most inclined to short, but it's on a tear right now, so we're not going to short it just yet. It was $19 the other day, and it's run up on a squeeze to 30. So what's that? It's 50% run. And I think it can keep going. This is the sort of thing that can really get squeezed. I actually don't even know what the short interest is on this right now, but I bet it's pretty darn high, and I just wouldn't want to be short it here quite yet. Back in May it was 21, and it's actually gone up while things have really been deteriorating. I don't pay a huge amount of attention to shorts anymore. When I was on the hedge fund side, I did a lot more shorting, and I paid a lot more attention to short, the due diligence on that side of things. But so anyway, I don't pay a lot of attention, but I do know that this, fundamentally is deteriorating. I don't like it for a lot of reasons, and I do think it can keep running, unfortunately, for shorts they're playing this one. So what I'm going to do is, if it, keep it on sort of the watch list. If it pops up to 50, let's say, I will be shorting it like crazy, and it will actually be a decent weight, I would say. Now, with shorting, you have to watch out for your borrow rate, or your fee rate. What that is it means you're actually borrowing money, essentially. I won't get into the mechanics of shorting just at the moment, because that's a tangent, but essentially you pay an interest rate when you short, and that interest rate can be as high as, I've seen, 250%. In fact, I accidentally paid 250% once. It was, I mean, in fairness, it was intended to be like a week-long trade, so I, plugged my nose and did it. But yeah, so yeah, the fee rate could be too high. So if this was up at $50, for example, and the fee rate was 100%, I probably wouldn't do it. The timeline is too hard to know. It's, the math doesn't work very well, put it that way. So yeah, some shorts potentially lined up. No weightings given to that end of things at the moment, and again, the math is a bit funny there. But anyway, 110% on the equity side, 30% on the fixed income side, levering us up to 140. So the leverage is really in the fixed income play at the moment, at least initially. It's run a fair bit lately by fixed income standards. It's yields are way down and bond prices are way up in the last week, largely precipitated by the Fed's decision that happened, that we spoke about before the event, and got long TLT and TLH and all those beforehand in the low risk portfolio here, as you can see. So yeah, that's the setup, that's the plan. Day one, we're going to do this a little bit more realistic, where I'm not just 100% invested day one. We're going to scale in a little bit more. We'll wait for a pullback. Maybe we don't get a pullback on some of these, and so then we cross them off the list and we actually allocate some of that to something else. So again, this will be a little bit more realistic of the way that I would typically operate. Waiting for pullback, essentially a watch list in a way, but a very specific watch list with predetermined targets. Some of these we're going to buy half, so we're going to sort of scale in a very basic way to some of these. Often in real life, I would scale in with 4 trades, 5 trades, 10 trades sometimes. But we're going to buy half, and we'll buy the other half, hopefully on a pullback. And this portfolio is full of, well, not full of, but it has some junk in it, right? There's things like herein, which is very questionable. This is actually a Boxster. Oops. And I'll have to clean this up. This is all pretty rough right now. I did include market caps because I think market caps, which is the value of the company ascribed by the equity price, I included that because it gives you a sense of what we're talking about a little bit more here. Like Coupang is a $29 billion company. That's actually a proper company, This thing is 30 million. That's pretty much bankrupt, basically. I've allocated 0.5% to it. It might go to 0, and that's okay. It's less okay, though, because we're talking about a levered portfolio. If this was without leverage, well, 0.5%, it could double or it could go to 0, and, if my assessment was the 75% chance it's going to double and 25% chance it's going to not, 25% chance it's going to go 0, then you'd probably take that trade over and over and over, but in very small weights. But when you're dealing with leverage, as we are here, you got to be a little bit more careful with that. So it's a very small weight. Now, why are we buying junk, you might ask? Well, short answer is herein. Let's look at that really quickly. So herein, is that how you say it? Herein? Yeah, I think so. I don't know this company well at all. Don't really follow it that much, but it came across this screener or something. I just noticed it and went, hang on, wait a second. What do we have going on here? We've got a market cap. So the equity value of the company, determined by the stock price, essentially, and the number of shares outstanding of 121 million. So if I bought this company, I would more or less pay that. I mean, it's a simplification, but more or less pay that. But the funny thing is, if you look at this, the enterprise value of the company is negative 101 million. Well, how does that work? Well, I happen to know how that's calculated, and a large chunk of it is the cash position. Let's ignore the debt for now. So the cash is 231 million. Now, doesn't mean that's the current cash. That was the last reported cash, and that's an important distinction because if you look at their EBITDA, which is a measure of profitability, if you will, well, here's net income as well. Both of these are highly negative, meaning they're burning a lot of cash every year. So if you're sitting on 231 million cash and you're burning 160 million, that cash isn't quite as relevant. In fact, it doesn't give you a very long lifespan, does it? So this isn't that interesting, but what is interesting is you kind of have to be a little bit interested when it has a negative enterprise value. And so, back of the napkin math, at worst, it's a free company right now, provided it doesn't go bankrupt. so, So yeah, I like things that are free, and yeah, it's a bit of a gamble, frankly. It's a free company. If it gets a bit of life back in it, 5 years is probably awful. Yeah. So 1 year anyway. 1 year ago it was 360. So that gives you an idea of the upside. Maybe on a squeeze. I don't know how heavily this is shorted. I frankly don't follow it that much. Again, this is why this is just for entertainment purposes, blah, blah, blah. These are junky companies, and I don't necessarily follow them very closely. But I think this is right for some, a pop or a squeeze, especially when market conditions improve. So, it might pop to 122 and we'll say, you know what, good enough. That's fine. We're out of here. Thanks for the double. It didn't go bankrupt. We got a double out of it. Or maybe it actually goes exponential for a few months and ends up in the threes. That would be lovely, and we probably would have already sold anyway on the way up. But regardless, that's sort of the idea. So there's some junk in here. They have small weights, so yeah, sort of the idea. What else? Yeah, Ondas. Same idea with Ondas. And Pubmatic is kind of like a better quality version of that. We'll just jump to that really quickly as well. And yeah, Pubmatic, so stats, it's 630 million. So not nearly as penny stock-ish. Still not exactly I wouldn't call it a mid cap. Enterprise value is 480. Okay, so what does that mean? Well, it means they've got 170 million cash. They've got some debt. Again, let's just more or less ignore it. And the difference takes into account both of those. So they've got a bunch of cash. The real value of the company, if you will, is 480, not 630 if you were a buyer of this company. You see that in the price to sales multiple. I won't get into all this. This is too much detail for right now. But point is it's got a bunch of cash, and it's actually profitable. Gross profit of 168 million, EBITDA 32, net income, more or less zero. But behind the scenes, they're actually, doing okay. Decent gross margin if you look at the revenue level versus the gross profit level. So it's not a company that appears to be going bankrupt anytime soon. It's got a pile of cash, as I say. It's pretty cheap. It's ignore the PEs. They aren't really particularly representative of things at this point. But it's also, I suspect, down an awful lot. Certainly over 5 years. 5 years ago in 21 at peak, when the market was all hyped up, it was a $64 stock, and it's 12 today. I don't see a lot of risk here at 12. Financials don't look fantastic, but they've 113 million, 148 million, 226, 256. So they've been making progress. They're moving in the right direction. Again, let's not get into the details too much here, but yeah, there's some interesting companies mixed in with some junky companies, and we're using a little leverage, and there's an element of macro timing here, as with the other portfolios as well. Specifically sort of that dovish pivot that I'm looking for. Whether it be the Fed making that dovish pivot themselves or the market doing it for them, right? Maybe that's a topic for a whole different discussion sometime, but the Fed can sort of be forced to become dovish whether they like it or not, and that's sort of what we saw on Wednesday, I guess it was. The Fed wasn't particularly dovish, but the market was sort of reading between the lines, and they felt that the Fed was either going to be forced to be a bit more dovish, or there was hesitation around the hawkishness at very least. So the market's very good at seeing through the Fed these days, and in general. The Fed has to, or Powell especially, has to be so careful with his words. So anyway, yeah, bunch of junky companies in here for sure. But it's gonna be just a fun time. We're gonna have some fun with this, and yeah, just for fun. Definitely not to be followed by anyone for any reason. Not investment advice. You know the drill. But let's do this. Let's have some fun and see where this is in a few months and in a year or two. It will be a little bit more active maybe than I would like, because again I have to do the blotter for the whole thing and work out all the numbers, which is kind of a pain in the butt. So it'll be certainly again less active than if I was really running this portfolio. But that's okay too. It doesn't. It'll still work. Yeah. Provided that the market doesn't just completely tank from here. And that's a good segue here, just briefly. There's very good reason why the market could or should tank at this point. So it's a very binary period of time. There's a lot of people that are very bearish right now, and they have good reason to be, frankly. I think even Druckenmiller said this a while ago. Stanley Druckenmiller is a very famous investor who has an incredible track record. I think he said he's like more confused than he's ever been right now. And, in other interviews, I think he said, the outcomes are very binary. So it's not a slam dunk. We are making some pretty strong calls here, obviously. I'm implementing a market timing call on top of course stock specific picks. So it has the potential to go pretty wrong if there's a true risk off event that we've been sort of trending towards. Maybe our fixed income will save us a bit, and then I would have to scale back some of the exposure as well, right? The one saving grace is, in my view, a lot of these are already down an awful lot, and so at some point you can't get cheaper. Which reminds me of, speaking of cheap, do I have it in here? Yeah, HIMS. I mean, HIMS is just incredibly cheap. I see something like this and I look at the metrics and I just scratch my head. There's a number of these that if the market tanked 50%, I don't understand how HIMS could go down 50%. It's that cheap that at some point the business fundamentals have to matter, because someone would come along and buy it, frankly, right? I mean, if it's that good of a business, or at least the growth prospects are that good, in conjunction with the profitability, the gross profit that they're showing, and so on and so forth. I mean, there has to be a bottom. We ran into this in the COVID decline, right, when the panic happened. I was full long at the time, not going into it. Sorry, I was short actually going into it. But at the bottom, I was full long. For a number of reasons. The main reason I was full long, frankly, with a little bit of leverage actually on the long side at that point, because I had become so bullish in the decline, contrary to absolutely everyone else, it felt like. The Fed was quite literally telling us they were going to do everything they could to arrest the fall. Trump was in power at the time, and Trump was like, on the megaphone every day, basically saying that he would personally stop the stock market from falling. Pretty much, it was getting ridiculous. But it wasn't just that. It wasn't just that the government was telling us, well, frankly, that's the Fed put that everybody talks about. It wasn't just that. It was that the valuations were just getting really, really cheap, and really attractive from a pure real world point of view. And this is a huge tangent. I'm sorry, but it was absurd in some ways, right? Because you had the Fed telling you that they were going to slam rates down to zero. So there's essentially going to be no return in fixed income for you. If you let's imagine that the market just stopped. Everything sort of stopped at the bottom of that COVID decline. Well, what did you have? You would have had like the 10-year bond paying zero, 20-year bond paying pretty much zero too. So if you're an investor at that point, after that, let's call it like freeze, if you will, and you pause there for a while and you really think about it and you start to go, gee, what am I going to do with my money now that everything's just flatlined at the bottom? Well, you're not really going to buy bonds because they don't pay you anything. So what are you going to do, right? You're going to start to look for good quality companies that have, strong dividends if it's an equity, or you're going to look for, a fixed income instrument that's paying like double what it was, a little while ago. Fixed income being something with risk, right? That is now demanding a massive risk premium, hence, the effective yield, if you will, from now until maturity. So anyway, the point is that there was a lot of really good value like everywhere at that point. And it was sort of a no-brainer to be long, like unless you really thought the world was ending, I guess. But even then, I mean, I don't know. It was kind of ridiculous. So anyway, I was very, very long at the bottom. And that kind of goes back to the HIMSS thing here, right? Where, even if the market crashes 50% from here, I'm not sure that means some of these things crash 50%. I mean, they probably, a lot of them probably would, just from a sheer beta point of view, beta being that, they move with the market at the very least, or maybe more in some cases because they're small caps. But at some point, fundamentals just have to start to matter. But because this is, levered, I would then have to reduce some exposure if we were sitting fully exposed. Again, we're not going to be initially because we're just waiting for a pullback on some of this stuff, and we're buying half on others and whatnot. But we'll see. And at the end of the day, as much as there's logic in scaling into things and blah 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 blah. I mean, no one can tell you that this approach that I'm proposing here is going to work better than just buying everything on the open tomorrow. I mean, it might. It's a coin toss really at the end of the day. But I didn't like what happened with the medium portfolio. That was unfortunate. So we're gonna play this one a little bit more true to life, I suppose. Yeah. So that's it for now. I think that's plenty of information about this degenerate portfolio that we really shouldn't even be talking about in the first place. So let's. I'll update you tomorrow morning. I'll get our average costs and stuff. Hopefully, I'll keep it a really short video. But basically, all I'll do is grab the open prices for everything I have marked here, and we'll omit these guys and buy half of the others. And should be a very short video. It's just going to be to grab the average prices, basically. I hope. But yeah, let's enjoy watching this one too. So should be fun. Okay, have a good evening or wherever you are in the world. And this is the Blind Pilot signing off.
Decline of interest rates by 20 percentage points over that period was a dominant factor in the financial world. I think it was the most important single event in the financial world in the last 50 years.